Gold extended gains above $2,000 US an ounce this week on Tuesday as the dollar yields fell, while weaker US economic data kind of emboldened bets for slower rate hikes despite mounting concerns over oil-led inflation. So the precious metal, the little yellow metal gold, is now roughly $35 away from trading at an all-time high of US dollars. It's $2,075 per ounce. That was reached in August of 2020. Now, one approach we have used to participate in growth of a sector, particularly in highly risky sectors like gold, is known as the picks and shovels approach. So what is a picks and shovels approach? Well, essentially an investment strategy that invests in the underlying technology or the service or tools needed to produce a good or service instead of the final output. It is a way to invest in an industry without having to endure the risks of the market for the final product. Now, this investment strategy is named after the tools needed to take part in the California gold rush, which is appropriate for our case study today. While the allure of finding the next great gold mine is always sexy, it turned out the most profitable business during the 19th century gold rush was actually just to be selling the tools every starry-eyed miner needed to find gold. The picks and shovels providers were the ones actually getting risks, not those actually mining for gold. So we use that approach today. With the price of gold poised to hit all-time highs, we update listeners on a stock we have recommended to our clients over the past 2 years, which provides the tools necessary to find and increase the life of gold mines. That company, Geodrill Limited, symbol GEO on the TSX. It was recommended in February of 2021 at a price of $1.60. Closed today around $3.50. The stock is up 33.21% year to date in 2023 and up over 120%. Including the dividend since Keystone recommended it at $1.60 in 2020. Now, the market cap is $163 million. It yields its dividend payout or pay is 1.71%. What does Geodrill do? They were established in 1998. They are a mineral exploration drilling company that primarily in the gold-related sector in West Africa, Zambia, and Peru. It offers reverse circulation, core, air core, deep directional drilling, reverse circulation, grade control, water borehole, underground, mine blast hole, and horizontal drilling services. Everything you need to find a mine and extend the life of that mine. The company's current fleet stands at 76 rigs. That's up one versus the Q3 2022. With an additional rig being manufactured and 4 currently being rented, it will bring the total to around 81. Approximately 60% of the fleet is tied up to existing customers over the next 3 to 5 years. Geodrill continues to expand globally, having signed its first contract ever recently in Chile, as well as 2 new contracts in Egypt. The company's client mix is made up of senior, intermediate, and junior exploration companies. So what is driving the share price over the last couple of years? Well, strong financials this year. In 2022, these figures are in US dollars. Revenues were up 20% to $138.6 million. Net income jumped 34% to around 41 cents per share. That's 56 cents roughly Canadian. They ended the year with net cash, excluding right of use liabilities, of about $9.8 million. They delivered 6 cents in dividends to investors in 2022 compared to around 2 cents Canadian in 2021. Now, what else is driving it? Well, the surge in the gold price of late from its lows in November in the range of US dollar 1630. Gold has risen 25% to about 2040. That's a significant rise in 4 months and bodes well for capital inflows into the sector at present. The more money that is raised that goes into the sector, the more money goes into drilling, and a company like Geodrill can benefit from that. Now, our take here, while the stock is up over 120% from our recommendation, on a valuation basis, Geodrill still trades at 5.8 times 2023 expected earnings and 2.65 times its expected 2023 EBITDA. A client recently asked if we saw Geodrill as a takeover target. Well, firstly, we never make an investment in a company based on it being just a takeover target, as that is highly speculative. Having said this, if we're going to go down, partially at least down that path, in terms of acquisition equivalence, There is not an exact comparison, but Major Drilling, MDI on the TSX, the largest driller in this segment, acquired a company called McKay Drilling Pty Limited, a leading specialty drilling contractor. It's based in Perth, Australia. It paid around 75 million Canadian in 2021. The transaction was at approximately 4.7 times EBITDA. Geodrill will have more than double its EBITDA this past year. It had more than double, so it likely deserves a slightly higher multiple. Geodrill currently trades at 2.65 times 2023 expected EBITDA. So there's your comparison. We would not buy Geodrill or any company strictly based on a takeover target, as this is a poor strategy, but it gives you the comparison there. What we do know is that Geodrill is likely to post record earnings again in 2023, and this has driven the share price over the past year, and the current execution is strong. It continues to be a unique way to gain exposure to the gold price without the geological and technical risk of mining. Again, it trades at about 2.5 times 2023 expected EBITDA. It's below its peer group in the Americas and Australia, which is likely not justified by the business fundamentals. And that is my take on a picks and shovels way of participating in the gold segment.
And clients have been receiving a dividend that is growing. Like in 2021, Geodrill ended up paying out 2 cents for the year, I believe, in dividends. In 2022, they ended up paying 6 cents per share. And this year, we're looking at, they just ended up increasing their semi-annual dividend to 4 cents. So we're looking at 8 cents per share this year. So, we're seeing them grow that dividend, which, is bringing in, long-term investors to the story as well, rather than just traders, which is always something that we like to see as well. And I mean, I always like just sitting back, collecting some dividends. It's especially when the market's, getting hammered or whatnot. It's always nice, seeing those.
Yeah, and they keep getting increased.
Exactly.
So your effective yield, like you said,
Yep.
goes up over time, which is great to see.
Yeah. I remember Warren Buffett, just on the topic of gold. I remember Warren Buffett several years back in his annual report, he was talking about gold, and he was running his own valuation on it. And he had essentially boiled it down to, if you were to take all the gold in the world, the entire supply, jewelry, stockpiles, everything else, you're to put it in one place, combine it. Can't remember exactly how big he said it would be, but it'd be about the size of a football field, I think, more or less.
Or like Olympic swimming pool, maybe?
Something like that, yeah.
Yeah.
And he made the point that, it's a nice, shiny, large piece of metal, but it doesn't actually do anything for you. You can't eat it. You can't create electricity out of it. It has, minimal industrial value. And then he came up with a total value, and then essentially, figured out that, you could buy that big block of gold, or you could buy all the farmland in the United States, plus, several of the most valuable companies in the world, and have like a bunch of money left over. So this was old. This was many years ago, and obviously the
2012.
But
I got it up. It was a tennis court.
A tennis
there
court.
You go.
It's shocking. It's shocking how small the
it's fairly small, right? So I just kind of did a really quick,
although it weighs a lot,
a really quick analysis here on what that would look like right now. So right now, the stockpiles, like the combined value of all stockpiles of gold, I think is estimated to be a little over $10 trillion, say $10 to $11 trillion. Now, if you were to look at the entire tech sector in the United States right now, publicly traded, that would be valued, I believe, like roughly around $5 to $6 trillion. If you were to look at all farmland in the United States, so this is Statistica as of 2021. It's a little bit old, but they have a valuation of about $3 trillion. So if you're to say, take the entire tech sector, publicly traded, so this is Microsoft, Amazon, this is Apple, this is, a lot of other companies that are huge innovators. You could buy that entire sector for, say, $6 trillion, or that's valued right now for $6 trillion. You add another $3 trillion, you get all the farmland in the United States. So now you're up to $9 trillion, and you still have $1 trillion left to buy a bunch of jewelry, put $1 trillion worth of gold. I mean, that's what the valuation would look like right now. I'd probably take the companies and the farmland, and I could buy some nice gold jewelry for my wife.
Oh yeah, I mean, I agree.
Yeah.
Oh, for yourself, the
For
jewelry.
myself,
Let's be
of
honest,
course, because
right?
I
You'd
love
bling
to
yourself out.
That's
At
really
that
just
point, right?
honestly, that's just a
Gold
quick
tooth,
2 to
maybe.
3 minute analysis. So don't quote me on it, but I was curious because when you're talking about gold, it reminded me of Warren Buffett's valuation. So I figured I would look
Well,
up a couple of the current numbers.
and I would add just like a word of caution investing in commodity-based stocks. It's very risky business. You have all the company-specific risks essentially you'd find in any stock, including like looking at the quality of a management team, the prospect for growth in the business, execution on their stated targets, the cash flow, the balance sheet, the price you are paying for the stock at present. And you have the market risk, including general market sentiment, like economic conditions. Plus, you have the commodity risk. Typically, if the commodity stock produces or commodity the stock you're buying produces or is associated with, if it goes higher, the stock does well. If the commodity moves lower, the stock does poorly. The degree to which the stock underperforms or kind of overperforms this can depend on the quality of the company, yes, but the general direction is driven by the commodity price. So even if management of a gold company does everything right, I say this all the time, in a year, if the price of gold moves against them, it will likely not be a good year for that stock. So, I mean, that is, you have an overlay of risk that's higher than your average stock when you're dealing with a commodity.